Russell Napier, strategist Asia at CLSA, joins us on the show. Russell, hi, good morning. You had stated in the past that there will be one more deflationary bust. You said that you see the S&P 500 index falling all the way to 400. What makes you so bullish?
Sure. Well, my concern about deflation is about a lack of global money supply or a lack of growth in money supply, which will sound very peculiar because we all know that developed world banks are so-called printing a lot of money. But what your viewers have to understand is an expansion of the central bank's balance sheet does not necessarily create money. It very directly creates bank reserves, but doesn't change very much the total amount of money in the system. So in the West, the developed world, we really don't have very much money supply growth at all. It's about 3 to 4% in the United States of America. It's below zero in the United Kingdom. It's about zero in Japan. It's about 2.5% and falling in Europe. Those are not the sort of numbers that one associates with inflation or reasonable levels of growth. Now, my real concern as to why these numbers could get worse all relates to the emerging markets. The emerging markets over the last 2 to 3 years have seen a significant deterioration in their balance of payments. Now, this has a direct effect on their ability to create money. I could talk about this at great length, but effectively they have run surpluses, created money, their surpluses have disappeared. So we should expect to see a fairly dramatic deceleration in their money creation. And if at all times and everywhere inflation is a monetary phenomenon, the lack of money in this new environment, in what I would go as far as to say will be a balance of payments crisis for some emerging markets, is the reason why we can get to a deflation risk. And as to when it's coming, I think it's coming very soon, because I see some weakening of exchange rates in emerging markets, which suggests we're getting close to the end game.
Right. So Russell, when do you see market reacting to such a deflationary environment? Will it be in 2013 or will it be in 2014?
I'm expecting it to happen probably in the first half of this year. There are some countries out there which are looking incredibly exposed. I hasten to add that India is not one that's looking very exposed. The countries that have a very exposed and dangerous balanced payments condition are one with large current account deficits, funding it particularly with debt inflows, more so than equity flows. And if we look at Turkey, perhaps South Africa, or perhaps Poland, these I think are states which are particularly vulnerable in 2013. So we've got to a stage where global money supply growth will be slowing fairly rapidly this year. So I don't see it being a problem postponed to 2014, 2015. I think it's a situation we're living in the middle of.
Right. So Russell, what do you make of the optimism there is about China in 2013? You have time and again highlighted that the Chinese reserves are contracting, and that doesn't spell good news.
Sure. I mean, the economic data of China is slightly better. It's clearly got some capital flowing back into China and making people optimistic. I would look at one factor and one factor only. Is it stopping capital leaving China? It's probably just a little bit too early to tell yet. We don't have the data yet. But the crucial problem I have with China is for the first time in its history, there is major capital exodus. Now, I believe that capital exodus is driven by the very poor returns on capital which private sector investors are getting in China. I see nothing in 2013 or perhaps even 2014 to change that. Many of these reasons for capital outflow are structural in nature. And I would caution anybody to be investing their own money in China at a time when Chinese people are bringing their money out at record high rates. So this is just not an issue of the Chinese people voting with their feet in terms of not wanting their own assets and preferring foreign assets. It has a very profound monetary effect, which we've really been talking about here already. And China has been a country where very high levels of money supply growth and credit growth have covered up many cracks in the structure of how business works. So this is not a good time to be taking a risk on China unless we can see something which stops that capital going out. So the short-term capital inflows, which have come along in the last couple of months, well, that's good news. But unless we change this capital outflow situation, then I think China will have real problems meeting growth expectations this year.